Hello guys, welcome to today's session in Quantsapp, and today we will be talking about how you can analyze the performance of your mutual fund investment, right? And with the help of that you can also make wise decision. Okay, now before starting the video, if you're new here, you can go in the description. There is the link of Quant Wealth application. Okay, after successful registration you will get some free tools in the application that will help you for your investment journey. As well as there is a video library also. So in our video library we have made multiple videos on investment and the various strategies, so you can go through the videos in your main time as well. They are available in multiple languages, and also at any point of time if you are having any kinds of doubts or query, so you can contact us. The number is shown here. Okay, so we will be there to sort your queries out. Right, so let's get back to today's video, that is how you can analyze the performance of your mutual fund, and with the help of that you can make informed decisions as well. Right, so let's see what we have here. So first of all, understanding mutual funds and performance. Okay, metrics, right? So first of all, the total returns, right? So let me select the marker here. Okay, now if I'm talking about the total returns, here, right? So total returns, it means the overall return. ठीक है, जितना भी आपने time में invest किया था, for example you have invested for 5 years. Okay, so the total returns, it means after 5 years, right? 5 years. So it could be it can be like recompounded interest. Okay, or if you your fund manager has not recompounded, so your profit will be different after the overall return, right? So it is shown here, the overall return from the fund over a specific period of time, right? It can vary if your fund manager is recompounding, or it can vary if he is not, right? Now the annualized return. So annualized return is the return that you are getting in a year. Okay, so for example you have invested 10 rupee. Okay, you have invested 10 rupee and you are getting a interest of, you can say, 10% here. Okay, so if you are getting a return of 10%, okay, annually, so after 1 year it will be 11, right? So that is your annual return, right? Now after this your total investment will be 11. Okay, and when for the second year, again 10% of the 11, right? So then it will be something like 11.1, right? So this is how you will get the annualized. So this is your return overall for the 2 years. Okay, and this is your return for the, or you can say, profit for annual one. Okay, so this is your annual returns, you can say, right? So there is a difference in between these two, right? Then there is a risk adjusted returns. Okay, risk adjusted returns means, it means returns relative to the risk taken. Okay, for example you are taking a risk of 10%, okay, or you have invested in a stock that is very much volatile. Okay, so if it is much volatile, then it means it has more risk, right? So if your you can say stock or the mutual fund, it has a volatility of 10%, so that means that is your risk. So in comparison to that risk, how much your mutual fund is performing, that is your risk adjusted returns. Okay, so we will see more about that in upcoming slides. Let's see. Okay, so then we have the key performance indicators. Okay, so this is the most important thing. First of all, the Sharpe ratio. Okay, so the thing I have told you before, that is the how much returns you are getting in comparison to your risk, that is this thing. So it measures the performance relative to the risk. Okay, so for example there are two mutual fund, that is A, and then there is a second B. Okay, the B is giving you a profit or returns of 20%, right? And the A is giving you a returns of 15%, right? But when it is giving you a return of 20%, so it may be taking more much risk, that is more much volatile, right? So that will be compared by the Sharpe ratio, like how much return it is giving and how much risk it is taking, right? So that is the ratio of your returns as well as of your risk, right? The market volatility. Then we have two important thing here, that is the alpha and beta. So I'll tell you that. Now if I'll talk about the beta, right? So for example your Nifty is giving you a overall return of you can say 20% just. Okay, for example, right? Then you have a mutual fund A and mutual fund B, right? So if it is also giving a return of 20%, it means the beta of that mutual fund is 1. Okay, 1. It means it is giving the same returns as comparison to Nifty, right? If it is giving you a beta of 1.1. Okay, it means the A is giving you 10% more returns than the Nifty, right? So beta is the term that will denote you like in comparison of the Nifty 50 indices, or you can say the benchmark, how much more return you are getting. Okay, so it is basically denoted as 1. Okay, so if there it will be 1.1, so it means 10% more than the Nifty. If it will be 1.2, it means 20% more than the Nifty. And if it will be 1.4, it means 40% more returns than Nifty your mutual fund is giving you, right? Similarly in the negative direction also, so for example below 1 there is 0.9, so 0.9 it means your stock is giving you or usually gives you 10% less return than the Nifty, right? So when we talk about the beta, so beta is the definite point, or you can say definite a number, okay, that is given to a stock or mutual fund, okay, how much returns it gives you in comparison to the Nifty, right? Then let comes on the beta. Okay, so for example beta, suppose there is a mutual fund, okay, A, and it usually gives 14% of interest, 14% of returns, right? And when we compare it to the Nifty, so the Nifty is giving you a 15% of returns, right? So 15% and 14%, right? So it will be, its beta will be less than 1, right? Beta will be less than 1, because as comparison to the Nifty, it is providing you, it usually provides less return, right? So it is expected from this mutual fund A that it will provide you a 14%. But at any point of time, if the A will provide you 16% of the returns, right? So it means now from the expected result, it has performed good. So there will be a +2. There will be a +2% of your alpha. So its alpha will be +2, right? So we when we compare the performance with your beta, okay, so then we got the reading of alpha, like how much more returns or how much less returns the particular mutual fund is giving you in comparison to the you can say the benchmark, or you can say the Nifty or S&P 500. Okay, it can be any indices, right? So I hope the meaning of alpha and beta is clear to you. Okay, let's go ahead here. Okay, now the performance comparison. So we usually compare it with the benchmark, as I have told you, like we can compare it with the Nifty, okay, or we can compare it with S&P 500. Okay, so these are the indices which we compare it with. Okay, so and the terms which are used in the comparison, that is your alpha, or you can say beta, or you can say Sharpe ratio as well. Okay, we have covered that in the previous slide. Okay, then the peer comparison means we are evaluating your mutual fund with other mutual fund of same kind, right? If it's a mutual fund of banking sector, so we will compare it with the other mutual fund of the same category, right? So that is your peer comparison. Then we have the historical performance. Okay, historical performance, it means, for example, if a stock was providing you a return of 14%, 15%, 13% and 12% over the years, right? So what will we do? We will take an average out of it, and for example, if there is an average of X%, so we will analyze, like in this year, how much more or how much less return we got from this average value, right? More than X, so it will be our stock is performing good. Less than X, it means the performance of mutual fund in this year was not that good, right? So that is your historical performance with which you can analyze the performance of your particular mutual fund, right? So that was the thing. Okay, then we have the analyzing fund holding. Okay, so first of all, we have the sector allocation. It means understand where the fund invest. Okay, so for example, if you have a fund manager, so you should always be well aware about like in which sectors your fund manager is very interested, right? If he is investing in the infra, if he is interested in manufacturing or healthcare or BFSI, right? So you should be well aware about it. Okay, and if it is working in the market or not, right? So that was the thing. Now then the top holdings. Okay, so you should always re-evaluate your portfolio as well. Okay, if you are getting 40% of the returns over the year in your portfolio, so just evaluate from this 40% which are the mutual funds that is giving you more returns, right? It could be like you have 5 holdings. Out of this 5, the overall profit is generated from only one. You can say the one is giving you 60% and the other 4 is giving you 40% only, right? So you should always focus on this one stock or one mutual fund that is providing you more returns, okay, and just go with those type of mutual fund again, though right, you can choose other mutual fund in the same category, right, that is providing you a return of 60%, right? So always reevaluate your portfolio. Then we have turnover rate. So it indicates how frequently the assets are bought and sold. So it depends on the fund manager also, right? If he is of active type, so he will make more turnover rates, and if he is of passive type, so there will be not that much of buying and selling of your mutual fund, right? So that was the thing. Okay, then if I'll go ahead here, okay, then we have making informed investment decisions. So in this we have align with your investment goal, okay, if you have a short term goal or long term goal, right? So that will be included here. Then we have consider the market condition. If the market is in sideways direction or the market is not fluctuating that much, okay, so then there will be less return, so you don't have to care about more returns in that scenario. But if the market is trending in one direction, then you can also plan for good returns in that particular time, right? Then review fund manager's strategy. Okay, so always get in touch with your fund manager, okay, if he is going with the market or not, if he is replicating the indices or not, okay, so you can also analyze those kinds of things, and always keep a touch with your fund manager and what type of strategy he is using, if he is going with the aggressive approach or if he is going with the passive approach, right? And you can also make the adjustment as well, right? Okay, then stay informed on the economic trends, right? What is the economic trends right now? So in economic trends you can also analyze the mega trend, right? Like in which sector or direction the current market is focusing on. If the market is focusing on healthcare more, so you can choose the mutual funds from healthcare sector. If the market is focusing on manufacturing sector, so you can go with those mutual funds also, right? So that is the thing, always keep yourself updated with the market trends, right? Okay, just a second. Okay, so now the conclusion: regularly analyze fund performance for better outcomes, use matrices to guide investment choices, and make decisions based on through research and analysis. So I think I have covered all of these, right? So आशा करता हूं कि काफी इंफॉर्मेटिव सेशन रहा होगा ये. अगर आपको पसंद आया, you can like it, you can share it with your friends as well, you can comment your views in the comment section, right? और thank you so much for watching the video. This is your trainer Ankit Singh Rawat. Have a very good day.